My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. We got to stop tonight, okay? Stop thinking about the stock market as one discrete thing. We have three markets, maybe even more. After a day where the Dow advanced 39 points, S&P declined 0.05%, NASDAQ dipped 1 basis point. I want you to forget about the averages for a second, or maybe for a week, or a month, or a year, or until the end of the pandemic. Thanks to the onslaught of the coronavirus, something that no one's ever seen, we're seeing something else that's incredible. Not just the complete untethering of Main Street from Wall Street, but the disentangling of even small publicly traded companies and medium-sized ones from the big dogs that have it easy and can handle this hellacious moment. We all know Wall Street isn't Main Street. That's how stocks can hold up even when we get yet another hideous job loss claims number like we did this morning. But now we're seeing even more separation, that is. It's stunning. In my 40 years of investing, I have never seen anything like what I'm about to talk about. So I'm going to walk you through what could amount to a destruction of a fair share of American business that, incredibly, might not impact much of the stock market, at least when it comes to the market's individual stock capitalizations. So right now, the stock market is divided into three buckets. First bucket, the companies that are big enough and deep pocket enough to ride out this quarantine no matter how long it lasts. Big businesses with great balance sheets are investable because we know eventually they'll be just fine. And they're especially investable when their stocks got hit on potentially fake news, like we saw with the Chinese data suggesting Gilead's antiviral drug remdesivir doesn't work on COVID-19. The word out of the U.S. hospitals I've been in touch with has been quite positive on this drug when used correctly, which is one reason the stock was able to bounce a little bit off its lows. Mainly, though, you've got a whole host of well-funded, large capitalization companies that have the wherewithal to simply outlast the pandemic, and so therefore you buy them on weakness. Second bucket, the companies that have been able to think on their feet, innovate, and actually come up with solutions to profit from the crisis. They don't like to talk about it like that, but I can. These companies also have good balance sheets, but they've gone above and beyond the first bucket. They're inventive, they're clever, and their stocks are screaming buys here. Look at Zoom Video. How much have we loved that company? Up another 12.5% today. Third bucket, the losers. This is by far the biggest bucket when it comes to the number of companies and their myriad employees, but not the capitalizations. Any company that needs credit, any company that's desperate for now non-existent demand, any company that makes solid loans that are now risky loans because of the pandemic, they're all in trouble. All of them. There are a ton of companies in that bucket, although for the most part, they're too small or medium-sized to have much impact on the overall averages, in part because their stocks have already been eviscerated. For example, Macy's, let's just use it. I hate to pick on Macy's because I love the store. My first credit card was a Macy's card, but Macy's is an iconic American company that's currently in dire straits. But with a tiny $1.5 billion market cap, it's not that much of a needle mover. The most important thing I heard about it was our terrific mayor, I won't even say his name because he's that terrific, said yes to having fireworks from Macy's. Well, thank you. That's very forward, very, 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 very solid, very rigorous. All right, so let's go over each bucket in more detail, starting with the first one, big business. Big business with deep pockets. I'm going to give you a classic example. Earlier this week, IBM, you know that company, they reported. And after interviewing the CEO, the new fellow, Arvind Krishna, I said I like the strategy. I said I like the company. Krishna's trying to aggressively grow his hybrid cloud business, something that's gotten a lot easier since he brought in Red Hat, one of our faves, to help convert customers that might ordinarily just go right to Amazon Web Services or Microsoft's Azure or Google Cloud. I think there's enough room for everyone in the cloud business that's growing so fast, and IBM's got a leg up with businesses that need good encryption, think Chinese stealing your data. At the same time, he's committed to maintaining IBM's juicy dividend, which currently yields 5.3%. So what happens? IBM reports a good quarter, stock gets clobbered. I tell you to buy it. because the balance sheet's strong and business is fine. Stock goes to 116 Tuesday. It's now back up to 121. I think it's going higher. Second example, the rails. Union Pacific, long my fave.
All aboard!
Yes, the big West Coast Railroad reported so-called weak sales. Cargoes were outright weak to subpar, exception of grain going to, our friends in China, and beer. Hey, who doesn't like beer? Both of which are thriving. But Union Pacific's done a remarkable job of cutting costs in recent years. It's so efficient that even with lackluster sales, it was able to crush the earnings estimates. I bet they keep delivering, even if the economy takes a long time to recover. And they pretty much said that. Oh, and by the way, management committed to keep paying its dividend, which currently yields 2.55%. Great balance sheet, so of course that payout's safe. It rallies $5 or 3.5%. Most people thought the stock would be down. They're not thinking about the new normal. How about the second bucket? All right, these are companies that were made for this moment, the ones that thrive in this new stay-at-home economy. Easy ones, Amazon, Walmart, Costco. Hey, we saw it today with Target. They're poised to carve up pretty much the whole retail space, leaving almost no one, other than maybe Home Depot and Lowe's. Even before COVID-19, these companies had the scale to get products much cheaper than their smaller competitors, which always allowed them to offer you lower prices. Now that so many smaller outlets have been forced to shut down already, the big box stores and Amazon own the whole industry, especially if they were smart enough to start carrying food. I'm going to throw in Dollar General there just as an afterthought. Oh, by the way, as Target CEO Brian Cornell told CNBC this morning, in April alone, our digital growth is up over 275%. We've just seen Cyber Monday occur almost every day, but the volume is twice the size of a normal Cyber Monday, end quote. Wow. The stock was down today. I bet analysts rallied behind it, especially given the fact when Shopify made similar comments, so they talked about Black Friday, their stock jumped gigantically the next day and the next day and the next day. Who else is made for this moment? Well, how about Kimberly-Clark and Procter & Gamble? I mean, come on. I mean, when you stay at home, you end up using more of their products, especially consumer toilet paper, because of all this social whatever we're practicing, physical, this or that. Regina Gilligan's not here, our executive producer, but yesterday she scored an 8-pack of toilet paper. I mean, holy cow, white gold. Yeah. Commercial toilet paper, the kind in your workplace, different splutching. So Hormel, yeah, Spam, that's a keeper. Smucker, peanut butter, General Mills, cereal, and that really expensive pet food that we feed our dogs, not that they know the difference. And Mondelez, think Tate's, but also Oreos. They're crushing it. Same goes for McCormick. Talk about liquid gold. Oh, no, that's urine when it comes to IDEX Labs. I forgot. Look at this. Oh, and if you're going stir crazy? You going stir crazy? Well, what did Chipotle tell us? Just drive through the Chipotle lane. Those guys know what to do. Then they're the shelter-in-place place. Zoom, Video, Ring Central, How Can I Help You? Zscaler, Okta, Cramer Family Fave, CrowdStrike. All these companies make it possible for you to seamlessly work from home. Underneath them, there's a whole infrastructure of cloud infrastructure. Yes, data center names, everything from Amazon Web Services, Microsoft Azure, Alphabet, Digital Realty, NVIDIA, AMD. Intel's different. So if that so-called weak quarter causes weakness in the ones I just mentioned, buy them. Third, stay-at-home wrinkle, the companies that prevent you from going crazy when you're stuck inside. Restaurants like Domino's that deliver. They got a pizza pedestal now, so they don't just put it right put it like on my saggy. I don't know if you see my porch. It's awful. Okay. And of course, here we got Netflix. Video game publishers. You get it. Finally, there's the unfortunate third bucket. And these are the ones we got to talk about. These are the companies that might require bailouts or are requiring bailouts, that are closing the doors, that may be nearing bankruptcy because they need credit and can't get it. The banks are in this leaky bucket. The oils, almost all retailers, the airlines, the whole travel and leisure court, hotels, you name it. The third bucket actually reflects the very real weakness in the economy. It's the bucket that people keep saying, why isn't the market down? Why isn't the market down? Well, this bucket is down. It's like the 22 million jobs lost over the past 5 weeks. These troubled companies are a lot like the small businesses that need money from the payroll protection program that's getting re-upped by Congress. In some cases, we actually had publicly traded companies abscond with our money. But the most important thing here is that the third bucket's a lot bigger than the first two when it comes to employees and when it comes to the fabric of our society, which is why it's so tough to own index funds here. In an index, you end up owning both the winners and the losers. And I think the third bucket will do better than the small, medium-sized private businesses, but holy cow, you don't want them in your portfolio. Until we get a vaccine that lets people safely go to crowded stores and restaurants and movie theaters and airplanes, they're not making a comeback. And a vaccine could take a lot longer than we want. Remember, the essence of those businesses is it's supposed to be crowded. In this day and age, crowds are the one thing you're not allowed to have. Bottom line, stop circling the wagons around index funds here. If you want to invest right now, you have to own some stocks from the second bucket, the COVID winners. And whenever the market gets slammed, you can buy members of the first bucket, the big businesses with deep pockets. But the third bucket, the losers, I think you have to sell them to any strength that we had this morning or yesterday. They're too toxic to own. And unless we get a vaccine real soon, they're going to stay that way. Brian in Oregon. Brian.
Booyah, Cramer, first time, long time.
All right, good to have you. My daughter lived in Oregon a long time. I like your state. A lot of trees.
A lot of trees, nice and green. Hey, man, I have a position in waste management that's 1.5% of my portfolio. Average price is 108. I was buying on the way down and thought this would be COVID and recession-proof. Recently got a lot of downgrades to neutral. Is this a balance sheet issue with their pending $5 billion?
Their balance sheet's fine. It's just you need a lot of construction for them to do well. People forget it's a construction company. I like fish. I like the stock. I think you should be a buyer. I think it's the right level. Marshall in Vermont. Marshall.
Hi, Jim. This is Marshall calling from Burlington, Vermont, with a question about Kraft Heinz. So this packaged food giant has been struggling with debt and declining sales for the past few years. But I'm wondering if it's now safe to buy, given the recent surge in packaged food sales.
I will say that even that, the worst company in its cohort, I mean, I am talking about a company that is the benchmark of bad, is better than, say, like any cruise ship stock you might want to buy. And Royal Caribbean was up $2 today. All right, the market's divided into 3 buckets. Please choose wisely, because one of them is real bad money today. Domino's, bucket 2, declined today. Buying opportunity, I'm going to talk to the CEO, find out whether it's well situated in a coronavirus-influenced business environment. Then while everyone was worried about bank earnings last week, you may have missed one of the strongest quarters we had, and that was from United Health Group, crunching the numbers. And it's a speculative biotech stock that's racing to find a vaccine for COVID-19 and is the #1 traded stock on Robinhood. It's Inovio. And I got to tell you, this Inovio, it's right from down the block from me. Inovio, right next to me. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.